Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
The assassination attempt certainly has a short-term positive impact for former President Trump's prospects. I don't think it has a long-term prospect. I mean, I raised the Biden matter in part because, this was a seismic event in political terms, but yet it didn't have much impact on how people think about the election, which is saying something.
I think the idea that Trump is positioning himself as a crypto president, stems from before this latest rally, if you want to call it such. Bitcoin's rallied around 10% in the last 9 days. I was on here talking, 9 days ago, we were saying, how low can Bitcoin go? And now it's actually looking a little bit more optimistic.
When Apple sort of tends to introduce products, they are really ready for the consumer, right? So we don't see them jump the gun, not generally first to market, but at the same time, and we have a slew of already phones from Chinese competitors, from Samsung and others that have some of these AI features. So Apple's not first to the game, generally not, but when they do come, you have a high degree of confidence that whatever product they're coming up with is going to act extremely well.
We've got 1 hour to go until the market close. So let's take a look at the major averages here. We are on track now for records, not from necessarily the S&P and the Nasdaq. The new one, the newer entrant is the Dow. It looks like it's going to close at a record today. And the number to beat is 40,003. And it looks like we're well above those levels with this 0.7% increase today. The S&P 500 could well close at a record as well. 5633, the number to beat there. It's above that right now. We'll see if it closes there. The Nasdaq doesn't look like it is going to match its record. But nonetheless, seeing this rally here today, already stocks were rallying. And then we heard from Fed Chair Jay Powell around midday. And that served to, it didn't necessarily supercharge the rally, but it gave it another underpinning.
It was interesting to hear Jay Powell speak because he talked, Julie, about the inflation data, and obviously to start the year, it had come in hotter than expected, but now, the inflation picture seems to be kind of improving. He talked about that. He talked about the economy performing well, right? Labor market coming back into better balance. Kind of not surprising when you hear Jay Powell talking like that you hear the July cut talk kind of bubbling up.
Yes, and notably bubbling up from Jan Hatzius, chief economist at Goldman Sachs, who was out with a note today saying, if the groundwork is there to cut in September, why not just do it in July? If the rationale is in place, why not just do it sooner? So we'll see what ends up happening. Powell was asked about timing today. He said, I'm not going to give any indication on timing. We'll see what ends up happening, but that does seem to be...
But that Goldman note was interesting because he said, they said base case September, but I think, kind of said, listen, if you were looking for a rationale for July, they get it.
Yes, exactly. So that's one thing affecting the market today. The other main underpinning of the market, as it were, is the assassination attempt on former President Trump at the rally over the weekend. This seems to have raised the betting odds that Trump will be the victor in November. It's still early, but we're seeing it play out somewhat in the broader markets, but definitely in some other assets, right? We are seeing it, particularly Bitcoin, getting a bid off this. He is viewed as a more crypto-friendly candidate, which is a switch.
And he's actually, listen, he's positioned himself for that.
Actively
he's
courting those folks,
that. We've had Bitcoin fans come on and talk a lot about that with our show. So it is interesting, though, Julie, because you're right. So investors sort of, betting on increasing odds he takes the White House, then trying to figure out what that means for the market, which is, there's just so many, there are interesting puts and takes because you think Republican and you think, okay, lower taxes, less regulation. At the same time, with Trump, tariffs, right? He pounds the table on that. Spend. He and Biden, they're not going to address entitlements. So there's just a lot of puts and takes to think about for investors.
Well, and you have heard some investors say, forget about trying to figure out what it means for the entire market. You can focus on some individual groups, right? So, for example, you watch the rates market. Utilities are lower in today's session. Energy's higher, although solar stocks are taking a hit because Trump is viewed as less friendly to that sector. Financials higher today with earnings from BlackRock and Goldman Sachs. So it's not as though that's the only thing going on in the market is politics, to be sure. We're also going into earnings season, so that is also going to be front and center for investors.
All right, let's get another take on all this. For more on the latest market moves, let's bring in now Jeff Bookbinder, LPL Financial Chief Equity Strategist. Jeff, it is good to see you, and a great day to have you on, Jeff. And maybe we'll start in the politics, Jeff, because listen, you heard Julie and I chatting there. There's just a lot going on. Republican National Convention. That starts tonight, Jeff. Of course, there's terrible events over the weekend. The attempted assassination of former President Trump. Reports that Trump is going to pick his running mate today, Jeff. Try to help us walk through, as a strategist, Jeff, how you're trying to make sense of all that, what it means for the markets. What are you telling clients?
Yeah, well, first, thanks for having me on. I think that the key message for clients right now is be patient, right? We've had just such a huge run. And to us at LP Research, it looks like stocks may be a little bit ahead of themselves. So that's kind of high level, wait for a pullback, potentially buy a dip. Maybe we get a dip around election uncertainty. Maybe it's a geopolitical threat. We'll have to see. But that's our first message. In terms of the Trump trade, which is certainly getting a lot of attention today, certainly it makes sense for the energy sector to do well. It makes sense for defense to do well. That's another one. It makes sense for the dollar to rally, right? It makes sense for yields to go up and the yield curve to steepen. We're talking about tariffs and we're talking about deregulation. The banks certainly getting a little bit of a lift from that Trump trade. So you guys are talking about, I think, about all the right things. Those are certainly areas investors can look at if they want to try to position around a potential Trump victory.
When you talk about patience, though, Jeff, I think it's important to point out, and this is something you pointed out in a recent note, that people should stay invested. In other words, just because you don't necessarily like one candidate or the other is not a reason to pull out of the market because you think there's going to be a pullback. And you had a chart that showed if you had stayed uninvested during, say, Democratic administrations or Republican administrations, you would have missed out on an awful lot of market upside.
Yeah, that's right. That's from our mid-year outlook that we recently published. Certainly staying invested over the long term makes sense. Even though we have thought for a while that stocks were a little bit expensive, we have remained fully invested. That's been our recommendation. We're neutral on equities, and it really takes a lot to move us much off of that. The numbers here are very compelling in terms of staying invested. So certainly there were some Democrats that missed out on gains during the Trump presidency before. There's certainly the opposite as well. So staying invested, the stock market goes up something like 78% of the time. Staying invested over the long haul makes a lot of sense. It's very unlikely that you're going to get declines over any meaningful period of time.
Jeff, did I hear you just say you were neutral on equities?
That's right. Yeah, we're recommending.
Why is that? Why is that, Jeff?
Sure. Well, first, the earnings environment's pretty good. We're probably going to get a double-digit earnings growth number in the second quarter, or the first quarter when the second quarter when the numbers are all in over the next 5 or 6 weeks. So that's one. Second, we use technical analysis as an important part of our process, and the momentum is certainly very, very strong, and that suggests staying with this market. And then, we are about ready to get to a Fed rate cut. And, if the economy holds up, it's slowing, but if it holds up, there's a good chance that, we see some more gains here over the next several months, despite the fact that markets tend to pull back in the second half. Whether it's an election year or not, whether it's a good year or not, you do tend to see somewhere around, let's call it 7 to 10% drawdowns in most years.
Jeff, of course, you mentioned Jay Powell. We heard from him today in conversation with David Rubenstein in Washington, D.C. And Rubenstein tried to press him on timing of the rate cut. He wouldn't give information on that, but here is what he said about the recent economic reports. Let's listen to that.
On inflation, in the first quarter, we didn't make any more progress. The second quarter, actually, we did make some more progress. We've had now 3 better readings. And if you average them, that's a pretty good pace. So turning to policy, your question, what we've said is that we didn't think it would be appropriate to begin to loosen policy until we were we had greater confidence that inflation was moving sustainably down to 2%. We've been waiting on that, and I would say we didn't gain any additional confidence in the first quarter, but the 3 readings in the second quarter, including the one from last week, do add somewhat to confidence.
So, Jeff, I would ask, do you think there's a chance we could get a cut as soon as July? And what do you think would be the equity market reaction to that, given that the Fed hasn't really telegraphed that timing?
Yeah, we think the chances are pretty low, but certainly it's possible. The house view at LPA Research is that we'll get 2 cuts, one in September and then one after the election. More interesting, though, is how many cuts are we going to get, right? And that's really where the 10-year yield is going to take its cues from. So, will that be 4 or 5? Will it be 6 or 7? It really depends on the economy. And then if you look at the historical performance of the S&P 500 after an initial rate cut, it's actually very mixed. So again, it goes back to the economy. If the economy grows and we're not worried about recession, stocks could add to gains after an initial cut. But certainly, we've seen 2001 being one example, 2007 being out of there. We've seen cases where the initial rate cut was actually the start of an economic decline. And that's when you saw losses initially in response to those cuts.
We talked a lot about the equity market today. For fixed income investors who are listening, Jeff, though, what would be your guidance there?
Sure. Yeah, certainly a lot of folks are talking about a big drop in rates. We don't think that's the right way to think about it. Again, if we just get a gradual rate cutting cycle, which is our anticipation, we will get maybe a little bit lower interest rates. But, over the long term, rates tend to follow nominal GDP. So a gradual economic slowdown aligns with maybe a gradual move lower in rates. So we still think this kind of 4% range, maybe 4.25%, is where we'll be for a while. And we also want to get our diversification from bonds. So we're telling our clients to, in general, stay diversified, use your bonds as defensive cushion against potential equity market declines, and then enjoy that income that we're getting now that we haven't gotten for many, many years. So we actually like fixed income a little better even than equities right now.
Interesting stuff. Jeff, thanks a lot. Appreciate it. We have some breaking news now. Former President Donald Trump has indeed named Ohio Senator J.D. Vance as his running mate for the 2024 presidential election. He made that announcement on Truth Social, which is the social networking platform that he uses. And he said he thought he was best suited to assume that position. A little bit about Vance. He is an Ohio senator currently. He did serve in the Marine Corps and then was a venture capitalist as well as a corporate attorney. In the past, well, I guess a little bit more distant past now, he had been critical of then candidate and President Trump, but the two have since made amends as Vance has sort of reversed some of his earlier comments. Of course, he's also the author of Hillbilly Elegy, which was something of a memoir/social commentary. Our Rick Newman is here now with more on this choice. Hi, Rick.
Hi, guys.
So does this indicate some level of comfort on the part of Trump with his chances now in the broader election? In other words, what does Vance do for the ticket?
I think of J.D. Vance as maybe he's like the next generation Trumper. So when Donald Trump is no longer a political force, who will be the driving force of the political party? So maybe now it's J.D. Vance. I mean, just to put this in context, I mean, a lot of times there's not a lot of going on in the campaign. We know who the candidate's going to be, so there tends to be a lot of drama. This is the next thing that's going to happen. He's going to pick his VP nominee. Who's that going to be? Everyone wonders that the parlor guessing game and all this kind of stuff. Then it happens. Then it doesn't matter very much. So I think J.D. Vance matters at least in this one regard. I mean, if Trump wins, I mean, he's almost as old as Joe Biden. And if whichever one of these guys wins, assuming they're the two candidates in November, we're going to have the oldest president ever. So you could say the odds are higher than usual that the vice president actually might end up taking the job. So voters do need to decide, do they think J.D. Vance is qualified to be president if Donald Trump wins and then Trump ends up indisposed or he dies in office or something like that. In terms of the election, he's from Ohio. Ohio is already a red state. Nobody thinks Ohio is a swing state anymore, so I'm not sure he does anything for Trump electorally. Go back to when Trump chose Mike Pence in 2016. Pence did something important for Trump, which is he gave him cover with evangelicals. And Trump did get the evangelical vote, and that actually, by some measurements, put Trump over the top in 2016. I don't see that J.D. Vance is going to do that in any meaningful regard.
But he didn't really have he wasn't in danger of losing that vote necessarily this time around, right?
I'm not so sure about that. I mean, Joe Biden is a practicing Catholic, and Donald Trump, we don't even know what he is, except a guy who holds a Bible up in the air every now and then. So I'm not so sure about that, although evangelicals would be, they're probably not as important in the swing states that matter. Also, not a woman. So Trump could have, there were some women on the list Trump could have chosen, which might have helped him a little bit with the problem that the Republican Party has with abortion. And suburban women in particular,
you're kind of going
so not going in that direction either. So two white guys on the Republican ticket.
I guess my question is, Rick, do you think J.D. Vance brings people to the ticket?
No, I don't.
Trump wouldn't have been able to
I don't see how he does. And vice presidents, for the most part, don't do that anyway. But
that was sort of like the narrative. You heard that out there. Well, Trump needs somebody who can at least give him a chance to reach more independents and moderate suburbanites.
I'm not seeing it because J.D. Vance, so as you pointed out in the beginning, Julie, he was an anti-Trumper at the beginning, and I think it's about a 99% likelihood the Biden campaign is going to be running ads of J.D. Vance, for the old J.D. Vance, trashing Trump. I think everyone's going to get pretty familiar very quickly with things J.D. Vance has said against Trump in the past. But to me, he's kind of like a mini Trump. I mean, he had a Trump conversion. Trump backed him and probably helped him win the Senate seat in Ohio in 2022 against Tim Ryan, who was a pretty good Senate candidate then. He's a convert to Trump, and he's just in the Trump lane. He's been in the Trump lane since he got elected as a senator in 2022. So I don't think he goes out very far outside and grabs many independents.
Well, let's take a step back for a moment, because obviously we are coming off of a very momentous weekend and tragic weekend with the attempted violence against President Trump and the killing that did occur at the rally over the weekend. We've been following several weeks of intense speculation about President Biden's age, whether he would remain the candidate. Now we swing back to whatever happened this weekend. We were swinging back to a more Trump-centric news cycle with the beginning of the RNC. How should people who are watching the election, watching the polls, sort of read the importance of the numbers that we're going to see, the headlines we're going to see, et cetera?
I think people should go to the beach, go on vacation, go to the pool, go cool off somewhere. I think people should just forget about it. Frankly, if you're a politics geek, the conventions, you want to know what's going on at the conventions. I think they're so totally boring. Who wants to watch this? People will tune in for Trump's speech on Thursday. If you're going to watch anything,
you think he shifts his tone there at all? Rhetoric, language.
He has telegraphed that he is going to shift his tone. I don't believe for 1 second that the
what
temperature.
He's been posting has not been much.
No, Trump. is Trump going to have a near deathbed conversion? I'd be astonished if he did. I think we're going to be back to the same old Donald Trump by September. Biden has to shift his tone. He already has. He has shifted his tone for the time being. But by the beginning of September, which is going to be the home stretch of this election, that is when the real fighting in the trenches is going to be going on. I think we're going to be right back to where we were, assuming Biden is the candidate, which he might not be. I think we're going to be right where we were, the minute before that kid fired the round from the roof in Butler, Pennsylvania.
Well, that'll be just in time for us to have come back from our beach vacations, and we
everybody
can start
should go
paying
put it out of your
again.
mind until then.
Well.
Just life advice from Rick.
In an ideal world, Rick Newman, thank you very much. Appreciate it. We're just getting started here on Market Domination. Coming up, we'll get more analysis of that selection of J.D. Vance as former President Trump's running mate when Market Domination returns. Don't go to the beach, or if you are, keep us tuned in. Former President Donald Trump has named Ohio Senator J.D. Vance as his running mate for the 2024 presidential election. And this comes after a pivotal weekend for Trump, the assassination attempt on the former president, providing a reason for new voices to come forward in support. Here with more on the presidential race, let's get to Fletcher School of Law and Diplomacy lecturer Gautam Mukunda. Gautam, thank you for being here. So we just got this news about J.D. Vance. You write and talk and think a lot about leadership here. So I'm curious, first of all, what you make of this choice from that perspective.
It's my pleasure. The leadership in general, and the presidency in particular. My last book was on the presidency, actually. So, I mean, one can only imagine J.D. Vance's feelings right now. Right? For Mike Pence, Donald Trump's last vice presidential nominee, it was being picked as Donald Trump's vice president was a life-altering and very nearly a life-ending experience. So Vance must be feeling quite excited. In terms of electoral strategy, essentially this pick signals that Trump has abandoned whatever attempts he might have been making after the assassination attempt to try and be a unifying figure. Like, those lasted for about a day, and they're over now. It is impossible to imagine a less unifying figure than J.D. Vance. When it happened, I was texting with some Republican friends of mine, and one said, well, I guess the vice presidential debate will be J.D. Vance versus J.D. Vance. Just to put this in context, there's been a lot of criticism of the rhetoric that where opponents of Donald Trump have attacked him. You know, they've called him cultural heroine or a con man or America's Hitler. And those are all things that J.D. Vance said about Donald Trump. So there are going to be some fascinating discussions about that.
Gautam, it tells, I wonder if it tells you that Trump is saying that with this pick, he's basically suggesting he's just so confident that he's got this thing locked up, really, because, you heard those chatter. A lot of folks were sort of suggesting, well, if Trump wants to reach more independents, moderates, suburbanites, he's got to go with, a Rubio, a Scott, Youngkin, a different candidate. To me, this just says I can go with the candidate who maybe, I don't know if you believe, we were just talking to our colleague who was saying it's hard to see how Senator Vance brings new folks to the table who weren't otherwise already going to vote for Trump anyway.
I think that's right. I mean, so there are two theories here. One is Trump is just saying that I am so certain I'm going to win that it doesn't matter what I do. And the other is that Trump is making a judgment basically based on who has been the most sycophantic towards him. And I stand in awe of J.D. Vance's skills in that department. I honor him. It's been impressive to watch. And so what I would think about this is, if you think about so just views that Vance has expressed, right, in the relatively recent past, the voting issue that is most likely to have an impact on this election, everybody on both sides agrees, is abortion. J.D. Vance has supported a total national ban on abortion with no exceptions for any reason. Right? You cannot imagine a sharper contrast with the Democratic ticket. He has expressed in a statement that he said that he regretted that one of the results of the sexual revolution was that women were free to leave abusive marriages. And that's his phrasing, not mine. You are setting up by picking him, you're setting up an astonishing contrast. You were also bringing into play, I'll just note, Peter Thiel, who has been J.D. Vance's patron for basically his entire career since he left Yale Law School. It's hard to think about a modern sort of member of a ticket who has been so uniquely had as a patron a single individual. And I imagine Democrats are going to be looking quite closely at Peter Thiel and wondering what sort of attack ads they can craft from that as well.
Well, and since you bring up Thiel, I think it makes sense also to bring up the other endorsements that Trump collected over the weekend from Bill Ackman and from Elon Musk. Not that either of them was particularly surprising, but again, it highlights sort of the business leaders who are willing to put their money and their support behind Trump. What do you make of that dynamic in the race?
So it is striking, right? So I always tell my students that when you're trying to understand an event, the most important thing you need to understand is base rates, right? So what is what you would normally expect the rate to be? So the base rate is almost all corporate leaders are Republican. That shouldn't surprise us, right? Most major company CEOs are Republican. Most major senior leaders on Wall Street are Republican. They are like that's just historically always been true. The Republican Party is the party of financial and corporate elite, and it has been since the day it was founded. And so what's really striking here is not that there are business leaders who are endorsing Trump. It's how few have. As my friend and colleague Jeff Sonnenfeld pointed out, up until Elon Musk endorsed Donald Trump, the number of Fortune 100 CEOs who had endorsed Donald Trump was 0. Right? For Mitt Romney, the number was, I believe, in the 40s. So that's a pretty striking difference, right? Like we've gone from 0 to 1. You can sort of dive into the particular questions as to why individual people have done it, right? What might have driven Musk? What might have driven Ackman? And, you can hear lots of gossip surrounding either of them about what that, and, gossip is worth what you pay for it, so that may not mean anything. But the most striking thing about corporate support for Trump is not how much there is, but how little, which is really surprising for any Republican nominee.
Gautam, it's great to get your perspective as always. Thanks for joining us.
Thank you.
Bitcoin getting a lift following the shooting attack on former President Donald Trump over the weekend. And with more on the crypto action, let's get over to Yahoo Finance's Jared Blickley. Jared.
Thank you, Josh. You'd have to go back to March to see a better day in Bitcoin. You can see it's up 6.38%. And then we've got some of the other tokens like Solana and Ether up even more. This is a 3-day look. And I just want to point out that Saturday, this was the time of the shooting on Saturday, that unfortunate event. This shot up the price of Bitcoin to almost 60,000, and 60,000 is an important level. This is a 3-day chart. I'm going to zoom out here to a year-to-date, and then I'm going to highlight the 60,000 price level. You can see it's been a virtual floor for most of the last several months, going back all the way to February, actually. And we did get a breakdown. This was a false breakdown at the beginning of May here. And then we had a more substantial breakdown last week. Actually, 2 weeks ago, this started. And this coincided with the German authorities releasing about 50,000. Well, they're going to eventually release about 50,000 Bitcoin as part of an unwinding event. And so all of those Bitcoin flooding the market, those offset some of the gains that we've been seeing, some of those flows that we've seen into the spot Bitcoin ETFs. And in fact, we saw $1 billion in flows last week alone. We didn't see it impact the price. In fact, we saw price fall off, but arguably that was because the German authorities were distributing those Bitcoins. So all in all, looks like kind of a wash. And we still have this bullish setup, technically speaking, for crypto. So here's Bitcoin. We are back above 60,000. That is bullish. Next in sight, well, you still got to clear about 73,000 to get to ultimate highs. But then you take a look at Ether. This is a similar looking chart, except it did not break down as much as Bitcoin. You can see just a little bit of a breach right there. And then finally, Solana, very similar chart, and bullish looking crypto chart there too as well, guys.
All right, thank you, Jared. Coming up, Apple shares jumping today on the back of a few bullish calls from Wall Street analysts. We're going to discuss that when market domination returns. So far, 2024 has been the year of AI, but is corporate IT spending reflecting that AI boom? Joining us now is John DiFucci, Guggenheim Senior Research Analyst. John, it's good to have you on the show. So you talk about, John, what you see as a new normal for software companies. Walk us through that, John. What do you mean by that?
Yeah, Josh, I think if we look back toward in recent history anyway, even go back 20 years, IT spending's been maybe 2 times or better than that of GDP growth. And software spending is probably better than IT spending. But over the last 2 years, we've seen software spending or IT spending be about what GDP growth has been. And why has that happened? People wonder why is that happening? Is it over? Is tech spending is that not going to be a high growth area anymore? I don't think that's the case. I think what happened is we had COVID, right? A couple of years ago. We poured money into the economy. Our governments did. Our government, other governments in the world. We spent on IT to get everybody to be able to work remotely. Interest rates were negative, so people had a lot of money, and they ended up spending on a lot of things. They pulled it forward, right? They pulled it back to spend it back in 2021 on things that they would have spent 2-3 years later. So now we have this little bit of a gap. We don't need some of the things we already spent on. Doesn't mean IT is not going to be high growth. It doesn't mean software's not. It's still a great area to be in. But we have to work through this, and we're not done yet. And it doesn't. There was this hope we were going to get this uptick in spending in the second half. We'll get an uptick. We always get a seasonal uptick, but it's not going to be the kind of year-over-year uptick that people had hoped for. Maybe it happens next year. Actually, it's unclear, but that's too far out. It's probably not going to happen in the second half, though.
Well, and John, what was so fascinating to me about your recent report on all of this is that, of course, a lot of the expectations for that boost in software spending has been tied to AI. And you're among the voices that recently, including the folks over at Goldman Sachs, has been sort of questioning the AI narrative, both the timing, the magnitude, even maybe the existence of the huge lift that this sector is going to get. Can you walk us through that part of your thinking?
Yeah, there's been some conjecture out there that AI is the reason why IT spending isn't as robust as people would hope it would be. I don't think that's the case at all. There is spending on AI. And by the way, I believe AI is going to change the world. It's already changing the world, and it will change the world. That doesn't mean that all tech companies are going to be able to monetize that. It doesn't mean they're going to be able to charge for it. They're going to improve their products with AI technologies. And we're going to benefit. We are, all of us, the users. But are they going to be able to charge more for it beyond the uplift they get every year on renewal? I know a lot of them probably won't. Some areas will. Cloud vendors will. Security vendors probably will, because even the bad guys will have a lot of AI, so there probably will be more attacks. Maybe some of the data preparers, data cleansers will. But that doesn't mean that every company is going to benefit from AI. And I don't think that what's happening out there today is because people are spending on AI, so they're not spending on other areas of tech. For the most part, that's not happening. The people spending on AI are AI companies. Some companies are spending on AI, but they're AI companies, and they're companies that want to provide AI for corporate consumers.
So, John, I'm curious, just giving your kind of broad views there. If you're an investor, you're listening right now, you want to commit capital to those software names. John, what would you suggest? What are some names you prefer here?
Yeah, Josh, I think if you think about where what names are set up well for the second half, they're usually some names that probably had some problems, so the numbers have come down already. For the most part, names they're a little too high. Numbers are too high, and they're probably going to come down for more than half of software names. Some names you can invest in, though. A company like Okta. Okta's had a breach, or an incident, they call it, a little more than a year ago. Or actually, it's not a year ago. It was back in October. And now their numbers have come down quite a bit. But they're doing really well, and we think it could be one of the best software stocks over the next few years. Another company you can buy, think of what I just said. There is spending on AI. Who's benefiting from that today? Well, NVIDIA obviously is, but the cloud vendors are. And well, what cloud vendor may have an advantage in that if they can provide, think about it, you need a lot of data and you need a lot of compute. So all the cloud vendors are going to benefit. What if one of them provided performance at a lower cost, better performance at a lower cost? They might benefit even more. Well, that's Oracle. I think Oracle's our best idea right now.
God, John, thank you so much for joining the show today. I really appreciate it.
Thanks, Josh.
Let's get to our call of the day. Good day for Apple, the tech giant getting an upgrade from Loop Capital to buy, and Loop is also raising its price target, along with another price target raise from Morgan Stanley. Those Apple shares are trading at a record today. Loop Capital's price target of $300 is the highest one on the street. And the analyst there is making this judgment. The analyst, by the way, is Ananda Barua, is making this judgment based on supply chain checks that show strong demand for the next generation iPhones that are sort of evidenced through the supply chain checks. And he, like Eric Woodring over at Morgan Stanley, says it does have to do with AI here and the demand that they expect because of that.
Yeah, Loop was really interesting, though, basically talking about how really AI, they say, is going to help Apple solidify itself as consumers' Gen AI, what they call a base camp of choice, just as it did for social media 15 years ago with iPhone and digital content consumption 20 years ago with iPad. Also, another interesting story, Julie, was Bloomberg citing sources. Apple's annual sales in India hit a record of almost $8 billion. Revenue jumped about 33% in the 12 months through March. Of course, Apple, we know, has been very focused on India, kind of looking to diversify beyond China. So that was an interesting headline as well.
Yeah, all of it interesting for sure. One of the numbers that stood out to me, by the way, from Woodring's note, is that Apple, he's predicting, will ship almost 500 million iPhones over the next 2 years, which would be higher than the cycle it saw in 21-22. And again, he, like Barua, thinks it's going to be AI spurred on by demand for AI.
Got to get your hands on those new AI-enabled iPhones.
I guess
That's the bet.
so.
Okay.
All right, big bank earnings are kicking off another season. Banks we've seen so far reporting mixed results, with analysts keeping a close eye on net interest income and how potential rate cuts could affect bank earnings. For more on those earnings, the earnings we've seen so far and what's on deck, we're bringing in Charlie Peabody. He's a partner at Wall Street Beats and founder of Portales Partners. Charlie, it is great to see you. It has been a minute, so it's a pleasure to talk to you.
My pleasure.
So, Charlie, from what we've heard thus far, it has indeed been a mixed picture. But if you can kind of zoom out, how would you characterize what we've heard so far from, so we've got among the biggest, JP Morgan, Citi, Wells Fargo, we got Goldman Sachs and BlackRock today as well. But on the bank side specifically, what's sort of your biggest takeaway so far?
Well, the fundamental trends have been strong capital markets and weak net interest income or spread income. And the question is that spread income going to inflect positively in the second half of the year? If it does, that starts to bring the regionals back in as a play. And we started to see that rotation in the second half of last week away from the big money center banks towards the regionals, with a continued bid in the capital markets names.
Charlie, I want to get your take too on Goldman Sachs. Of course, reported results this morning. Investors, Charlie, seem to like what they see. They're bidding this one up. Stock is now up nearly 30% this year. But you say avoid this name, Charlie. It's a sell. How come?
Well, short term, there's momentum in the capital markets, and so Goldman is a good momentum play. But we argue that their earnings stream remains much more cyclical than the market is valuing them at. And that's the big debate out there. In management, as they moved away from their failed consumer banking strategy back to their roots as an investment bank, have been trying to convince the street that there's a core underlying earnings power that's sustainable and stable. And I don't believe them. And I think once you start to see more volatility in the capital markets, and you'll see the cyclicality in the earnings stream emerge. So I think, we're seeing the best of that stock price right here, right now, and I would certainly sell it.
On the flip side, you, like Citigroup, there's been a lot more sort of belief seemingly in Jane Fraser's turnaround efforts at that bank. What was something sort of from this earnings report that really convinced you that she is making progress?
Well, I think Citi has a couple of things within their power that's not dependent upon the macro. It's kind of the opposite of Goldman, where they're very dependent upon the macro. They're, in the midst of a simplification reorganization process that's going to allow them to bring their expense structure down from 54 billion this year to 51 billion by 2026. They're in the process of improving the strength of their balance sheet, particularly the capital front. And I think they're going to be able to buy back, multi-billion dollars worth of stock at deep discounts to book. So that should improve their, ROTCE. In addition, there are certain businesses like their credit card business that are underperforming. And as losses in that business crest and come down, you're going to see a significant improvement in the returns and earnings of that operation. So we think that stock is going to, gravitate more towards book value as they improve their ROTCE from a 7% level today towards a 10 to 12% in 26. And in the meantime, we think they'll grow book value, towards over $100 in 26. So we think that discount to that $100 projected book value will narrow dramatically over the next 2 to 3 years.
Charlie, let's head to tomorrow morning. Morgan Stanley on deck. What do you expect to hear when they report, Charlie?
I think it's going to be more of the same, strong investment banking with an eye towards a pickup in M&A and IPOs in the second half of the year. And then trading will be driven more by equity trading and less so by fixed income trading. I'm looking for $1.68 in the quarter on about 14.1 billion of revenues.
Do you think that Morgan Stanley is subject to the same kind of cyclicality that you talked about with Goldman Sachs?
No, and that's where, what Gorman has done to transform that franchise has been significantly different than what Solomon has tried to do at Goldman Sachs. He's built a wealth management operation and investment management operation that have much more stable revenue streams. So I think they've dampened the cyclicality of their investment banking trading part of the franchise.
Charlie, thanks again. Appreciate your perspective.
My pleasure.
Coming up, we're breaking down the best ways to be positioned in the tech sector as part of today's Investor Playbook. Don't go anywhere. More market domination still to come. Investors briefly fled from big tech last week after rate cuts spurred a rotation, but there is still ample opportunity for investors within technology stocks, at least according to our next guest. We're looking at how to navigate the big picture with the Yahoo Finance Playbook. Joining us now is Dominic Rizzo, portfolio manager at T. Rowe Price's Global Technology Fund. Dom, thanks for being here. So we looked at that rotation. We sort of were trying to figure out whether that was a blip, whether it was a sign of things to come, perhaps, as we start to get closer to rate cuts. What do you think here?
Last week, we saw a pretty vicious tech rotation. I mean, the question is really going to be, is how strong are earnings coming up in the coming weeks? And it kind of depends on where you're looking at, if you're looking at hardware or software. Broadly speaking, I would say the earnings setup is a higher bar than it was, say, last quarter. We've seen tech outperform in the past 3 months, up 18% in total, and valuations are at the higher end of the historical range. That being said, within hardware, we've seen some really nice data points this quarter, whether it's an AI, server, PC, smartphone, that makes me more positive on the space. Software is a little bit of a trickier setup this earnings.
Why do you say that, Don? That software is a bit more tricky?
Well, you know, if you look at a couple of the different data points, I think we haven't seen that meaningful acceleration that some people were looking for into the back half, particularly in the application software. So you saw Dassault Systems come out and pre-announce negatively as customers have been pushing out some of these bigger contracts. We saw Accenture's numbers were relatively fine, but it's still 0 to 1% organic growth, nothing tremendous. And in general, I think there's a lot more momentum in companies getting their data ready for AI, which means less spend on applications.
And so where would you be looking going into the earnings season for big tech? Are there sort of subsectors or particular names that you think are going to be better positioned?
Yeah, I think hardware is looking strong heading into the prints. We've seen 4 data points that have been quite positive for the hardware ecosystem. First off, the printed circuit board space, the PCB companies, many of them have pre-announced positively in Asia, and I think that's a great sign for smartphones, PCs, traditional servers, and AI servers. Second, Corning had very strong numbers. You look at their optical business, that's what drove the growth, and what's driving that is really adoption of AI. Third, we just had SEMICON West last week, which is the big industry trade show for semi-capital equipment. And in general, I think people are looking for wafer fab equipment spend to continue its upward trend, China equipment spending to be stable. And then finally, probably most importantly, is TSMC's numbers. We saw TSMC had June quarter numbers of 40% revenue growth year over year and 16% quarter over quarter growth. It's just been really, really strong performance at TSMC.
Dom, you're still positive on NVIDIA, but you like AMD as well. How come?
Well, you know, NVIDIA has been our largest position for a while, and that's been a great place to be. If we take a step back, the AI chip market has just been absolutely on fire. We're going from a $45 billion AI chip market in 2023 to a $400 billion AI chip market by 2027. That's a 70% plus CAGR. And if we look at that, NVIDIA is the dominant player, and we think NVIDIA will continue to have the dominant amount of share. That being said, AMD has a real shot to be a second source provider with their MI300 GPUs. And I think that all of those major hyperscalers are looking for a second source to NVIDIA. Not to mention their core CPU business, whether it's on the PC side or on the server side, is starting to bottom. And their industrial business, which they got from the Xilinx acquisition, is also starting to bottom. And that comes in at very high margins. So if you look at AMD, I like the setup because we have a linchpin technology company, a company that's mission critical to the success of their customers. They have improving fundamentals, and you have revenue that's accelerating, operating margins that are expanding, and free cash flow conversion that's improving, and a fairly reasonable valuation.
Dom, we haven't talked as much about the Mag 7, with the exception here of NVIDIA. There are some expectations that the rest of the S&P 500, S&P 500, that earnings there are going to start to reaccelerate, and Mag 7 earnings are going to start to decelerate to some extent. Would you be lightening some of them here? Would you just be kind of standing pat? Kind of, how are you thinking about positioning for them going into earnings?
You have to respect the price momentum. We've seen last week this big reversal in the small cap stocks and the Qs, right? One of the biggest reversals that we've ever seen. That being said, the fundamentals at all of the Mag 7 companies are still very, very strong. So when I look at the earnings growth of those companies, we're looking at 20% earnings growth for the Mag 7 collectively. We're looking at high single-digit earnings growth for the S&P 493. And if we look at the multiples, the Mag 7 trades at roughly 30 times earnings. The S&P 493 trades at 17 times earnings. And so you're actually getting a cheaper PEG ratio for the Mag 7 compared to the S&P 493. Now, that being said, we've kind of seen the most extreme balance that we've had between mega caps and small caps that we've had in a long time. And it wouldn't surprise me to see that the small caps have some short-term rallies, but over the medium term, those Mag 7 stocks still like a good place to be.
Dom, thanks a lot. Appreciate it.
Thanks for having me, guys.
Now taking a look at Macy's, whose stock is sliding here after ending buyout discussions with Arkhouse and Brigade. Macy's CEO Tony Spring pledges a turnaround for the department store chain, planning to close underperforming stores while revamping ones with better sales to carry more on-trend products. So yeah, stock taking a hard tumble today, Julie. They end these buyout talks. Says the offer was not an actionable proposal, lacks certainty of financing. Of course, this story has been going on for some time. Back in December, the offer was nearly $6 billion, raised the bid in March, and again in June, but Macy's saying, you know what, no thanks, we're going to do this turnaround on our own.
Yeah, and Tony Spring's only been the CEO since February, so now the pressure is on him to do this turnaround effort. And in addition to what you were talking about, they're also going to expand Blue Mercury, which is the cosmetics brand that they own. The shares before today were still down year to date about 5%. So that didn't necessarily bake in a lot of optimism that this deal was going to get done. But now that that's removed, the stock is falling even further. You know, we've seen this movie before, that it takes a long time, even for storied department store retailers such as Macy's, to kind of have a decline. We'll see if indeed he can turn it around. Spring was the head of the Bloomingdale's franchise, which has performed better than the rest. So we'll see if he can apply that playbook.
I'll keep our eyes on it. While we're wrapping up today's market domination, do not go anywhere. We've got you covered with all the action following the closing bell.
There's the closing bell on Wall Street, and now it's market domination overtime. We're joined by Jared Blickery to get you up to speed on the action from today's session. Let's start with where the major averages ended up, and where they ended is off the highs of the session. Following that announcement that we got just a little while ago that former President Donald Trump had chosen J.D. Vance, Senator of Ohio, as his running mate, we actually saw stocks come off their highs a little bit. Whether that was the exact reason or not, the timing did coincide. We saw the Dow coming down towards its lows of the session, still finishing at a record today, up by about 0.5% or 210 points. The S&P 500, though, not closing at a record again today. It was there for much of the session and then again had that late leg downward, so finishing higher by about 0.25%. And finally, the Nasdaq also not at a record today, but up still 0.25%. So still showing a rally today. It's just not as strong as it was earlier in the session. We did, of course, have Fed Chair Jay Powell earlier in the day in comments in a Q&A session saying that now we've had 3 good reports on inflation, so he is more encouraged on the path of inflation, but he wouldn't commit to a cut in July versus September. And then there's one stock that I want to highlight today that has been the top of our trending list for much of the day, and that is Trump Media and Technology Group, up by 31% on the day. As we frequently pointed out, DJT, that's the ticker, is really the closest proxy for former President Trump's chances in this election. And so not surprising here, as we have seen the odds on various betting platforms go higher, some of the pundits out there talking about how his chances have been improving, that we see this stock finishing the day with a big, big gain. Jared's got a closer look now at the sector action.
Thank you, Julie. I want to just take a look at the small caps just for a second here. Russell 2000 ending up pretty close to the highs. So that sell-off that we saw late in the day, and by the way, it's no small thing to enact a sell-off during the highest liquidity portion of the day. But the Russell 2000 not feeling that sell-off. And in fact, here's the 4-day look, up 8%. And if I show you the 4-year chart, you're going to see how finally, it looks like small caps breaking out of this nasty resistance level that has just trapped them since the beginning of 2022. We'll see if it continues. But now I want to take a look at the sector action. Energy in the top spot. That is up 1.56% today, followed by financials up 1.4%. Then you have industrials and real estate, communication services. But really a day for value and cyclicals. Utilities was the biggest loser, down 2.4%. Also staples and healthcare in the red. So kind of a bullish day. The sectors that were in the red, largely those defensive ones, although not consumer discretionary. I'm going to show you the Nasdaq real quick so we get an idea of what the growth picture looks like, but then I'm going to flip over. I want to show you what's going on in energy. That was the leading sector of the day. We're going to get Schlumberger earnings at the end of the week. That stock up 3% today. Halliburton also due this Friday, and then next week we get Exxon and Chevron, but not this week. Also want to check out what's going on in the banking sector as we get those earnings rolling in. Guess what? JP Morgan up 2.5%. Goldman Sachs up 2.6%, guys.
Thank you, Jared. For more on the markets, joining us now is Bob Elliott, Unlimited co-founder, CEO, CIO. Bob, it is good to see you. So, politics front and center here, Bob. The big news, of course, Trump does officially pick Senator Vance as his running mate. The Republican National Convention is underway. Investors are, placing their bets, Bob, on who they think is going to take the White House. I know you've been following this very closely, Bob. What do you make of it? What are you telling your clients right now?
Well, when we look at what's going on in the market action today, and really since what happened over the weekend, where we saw an increase in odds that Trump would be elected to the presidency, we're seeing market action largely consistent with those increased odds. And so if you go line by line in terms of the market action, what we're seeing is actually gold as one of the best performing assets in the market, reflective of the fact that we're likely to get large deficits ahead as the Republicans have a higher probability of controlling all 3 chambers of the U.S. government. We're seeing bonds sell off as a function of growth likely being stronger and having those larger deficits and higher inflation. And we're seeing some stock rally, but not that much stock rally in the market, reflecting the fact that it's going to be challenging to keep up this level of growth with those level of deficits and upward pressure on interest rates. So you put that all together, it's not necessarily a great environment for overall asset prices, but it does favor gold and stocks relative to bonds. And one last thing to highlight is, of course, it's been favorable to Bitcoin as the Trump administration has pivoted and indicated a positive stance towards various crypto assets, and that's likely to be part of the reason why Bitcoin's rallying here as well.
Bob, I can't, as we continue to sort of parse out what each candidate's chances means for the markets, I keep going back to 2016, but there are lots of other examples where market participants thought that a candidate who then won the presidency was going to mean one thing, and it didn't necessarily mean that thing. So as you are trying to strategize based around all of this, how are you sort of trying to factor in the uncertainty level here?
Well, I think there's still a fair amount of uncertainty in terms of what exactly the policy mix is going to be. I think we're in a bit of a different circumstance than where we were back in 2016. We have a track record of policies, measures that both administrations have pursued over the course of their time in office. And we have pretty well-developed perspective in terms of what incremental policies will be. So I think we're in a lot better shape, a lot less uncertainty than maybe existed before. I think probably the increased uncertainty starts to emerge as we start to get to a higher probability that the Republicans control all three branches of government. In that case, there's a lot less constraints on policy making than may have otherwise existed in more divided government. And as a result, certain policies might be pursued that wouldn't have otherwise been pursued or even talked about during the campaign period. And so I think it's very important to recognize that probably uncertainty increases as the probability of full control also increases.
Is your sense, Bob, you mentioned there divided government, is your sense markets would actually prefer divided government?
I think there's a balance in terms of, a divided government is a lot more certain. Whether it's led by a Republican administration or a Democratic administration, I think there's a lot of, pretty much business as usual would likely transpire if we have a divided government. I think the challenge is we get to a bit more uncertainty as control of all three chambers emerges. And so I think that's the balance is probably more increase of control by the Republicans would lead to even more deficit spending, and particularly corporate beneficial deficit spending. But there's some uncertainty about that. And I think what we're seeing in the stock market not really rallying a ton on the incremental news is a reflection of that balance of increased uncertainty, more favorable policy, but also increased uncertainty.
Bob, if you were given the factors of the presidential election, and I guess let's call it the election overall because of the down market ballots also, earnings, and the Federal Reserve's interest rate cutting cycle, like how do you weight each of those when it comes to your strategy?
Well, probably the biggest thing that's going to determine how markets transpire, at least for the next, let's say, 3 months up until the election, is going to be how earnings and growth transpire relative to expectations. And I think one of the challenges that we see in this market right now is that there's very high growth expectations and very high earnings expectations penciled out through the end of the year. Something like 17% year-over-year earnings growth for the S&P 500 as a whole is expected by the fourth quarter. That's going to be pretty challenging to achieve in an environment where we see aggregate growth softer than it was, late last year, and where actual earnings growth has been closer to flat over the last couple of years rather than up. And so I think that probably that mismatch where maybe growth doesn't end up coming in nearly as strong as what's expected or priced into the equity market, that's probably the most important dynamic that's going to transpire. Once we get closer to the election, which is a few months ahead, if there is more uncertainty, then that will probably be a more dominant force. But in the interim, it's really about how the economy holds up relative to those expectations.
Well, we'll get more information on all of those factors in the coming weeks and months. Good to see you, Bob. Thank you. Coming up, AutoNation warns a recent cyber attack will take a toll on its upcoming earnings. We'll have more details on that and more market domination overtime on the other side.
Are you curious about what's happening in the ever-evolving media landscape? Whether that's breaking down the Paramount merger, what's going on with Netflix's pricing, learning the latest ways streamers are making money online, or you want to figure out what's the next best media investment opportunity. The media space is no longer as separated or as siloed as we once thought. Traditional media giants are adopting streaming practices, while streaming networks are implementing appointment viewing strategies. And YouTube, the wild card, may be beating them all. Join us for Yahoo Finance's Media, Streaming, and Investing. What's next? We'll break down the latest acquisitions and mergers, the state of the streaming wars, and tell you the stocks you should keep an eye on.
Let's take a look at another trending ticker today here on Yahoo Finance. AutoNation stock is climbing today after cutting earnings per share guidance for the coming quarter. Cyber attack on CDK Global, a software company catering to car dealerships, knocked the company's management system offline for 2 weeks, hurting thousands of retailers. And joining us now with more is Yahoo Finance's own Praz Subramanian. Praz.
Yeah, hey Josh. Yeah, so we're starting to hear more about the damage from that CDK hack. Happened around June 19th with systems down over 10 days or so, about 2 weeks before they're restored. Now, AutoNation is saying that this will hit their EPS by around $1.50 a share. It projected EPS of $3.15 to $3.30 a share before. I'm sorry, the analysts projected EPS of that before this. So we're looking at a pretty significant kind of hit here. So I think the big issue here for AutoNation and other dealership groups is that they're going to be under pressure, even from like 11 to 10 days of lost sales, because the end of June is such a high volume time for them. They're moving old product. It's end of the quarter, end of the month. It's a big deal for them. So what happens is a lot of these sales might get pushed into Q3, or they might be lost altogether. So we'll see what other dealership groups got to say about what happened to them during the CDK hack and outage.
It was interesting, too, because it seems like part of the lost revenue and whatnot, or the cost associated with it, is that they were still paying their employees. They still have to pay people, even if no money is going out the door. So it seemed like that was part of the issue at AutoNation, if I understood it correctly.
Yeah, they said it was split evenly between like lost sales, but also they have to have sort of compensation that they give no matter what to their salespeople, the sales staff, that needs to be paid out no matter what they do in terms of sales and quotas. So yeah, exactly right. That's half of the loss was because of this compensation to those salespeople who were recording no sales during that time.
Thank you, Praz. Appreciate it.
Thanks.
Google parent Alphabet reportedly nearing a deal to acquire cybersecurity startup Wiz. That's according to the Wall Street Journal. The groundbreaking $23 billion deal would be the largest acquisition for the company. For more on what Alphabet's move in the cloud cybersecurity space could mean for big tech, let's get to Jefferies senior analyst Brent Thill, who's joining us now to discuss. Brent, it's good to see you. So obviously this would be a big deal. A big deal at a time when big deals are scrutinized by Washington. So why is it so appealing that Alphabet might be considering this, even in the face of that perhaps scrutiny?
Yes, security is number one, and Google right now effectively is trying to get bigger trust with larger enterprises and small and mid-sized enterprises. So Wiz would effectively help build their credibility in ensuring your data is secure in the cloud. And that, again, remains the top CIO priority. If you recall, they were effectively in the hunt for HubSpot, which we never thought made a lot of sense, given it's an application company. They're not really in the app space. They were on Amazon, AWS. There were a bunch of other considerations. In this situation, I think that they can make the case that there is precedent. If you look at Palo Alto Networks, $100 billion plus market cap, Cloudflare. There are a lot of cyber names that have inherently higher market caps. If Wiz continued on its trajectory, certainly you could start to look out 4 or 5 years. Could the company independently have this type of multiple? So I think, relatively speaking, other cyber names were at that valuation, and they could, from a perspective on the financials, could make that actually work pretty well. So I was not a fan of the HubSpot transaction potential. I think this makes a lot more sense, given that they can address both small, mid, and large enterprises with this technology. The government, there's zero chance, in my opinion, they could push back on this because it's enabling the security and safety of data, and no one has dominant market share. So it would make a lot of sense for us. So again, we've heard a lot of chatter and M&A by Google. None of it's happened. Clearly, the HubSpot deal, at least in the interim, fell apart. But this deal, in my opinion, makes a lot more sense. I'd be a lot more excited as a shareholder if this was happening.
Brent, I also want to get your take kind of broadly on the software sector and what you see ahead in the back half. How optimistic are you, Brent? I asked, we had another financial analyst on the show earlier, sounded relatively more cautious on software. Where are you at?
I'm more excited because everyone hates software right now. I've said this. I feel like I'm changing oil underneath with no daylight, and it's been a tough front half of the year. So I think the sentiment is awful. Most of our big institutional investors are underweight software. Everyone is in hardware, semis, AI infrastructure. So I'm actually going to take the other side of this, which is I think that right now everyone is so negative, and I haven't seen this in my career for as long as I've done this, and how negative it is. So when you think about the sentiment and the setup, it just feels really bad. And as they say, invest in with fear and sell with greed. And right now we got a lot of fear. So I think it's go time. The IGV has been slowly making its way back up against the semi names. Again, I'm not expecting a breakout, but if companies actually maintain or even cut guide a little bit, de-risk the guide, everyone starts to look at 25, multiples have come in, you start to see more M&A, Trump gets in office and M&A comes back. I mean, my view is like it's more constructive for software, just given how negative everyone is. I can't imagine it getting more negative. Unless companies have to cut numbers by like 20%. I don't see that, but we just had Workday, Salesforce, a number of companies cut numbers. So I'm actually moderately more constructive because I think a lot of the bad news is already in these stocks.
Brent, I got to pick up on one particular thing you said, which is that if Trump wins election here, that the M&A landscape gets a lot more constructive. Is that how you think that would play out?
I think most are believing that it would be more business friendly with Republicans in office. Ultimately, I think that it could potentially help, and we'll see. We don't know, but perhaps that could help. And again, it's been too restrictive. If you look at past deals that have been shut down, Amazon trying to buy a vacuum cleaner company. iRobot, Adobe getting blocked on Figma when there was no overhang. And again, I know these were EU decisions, not US decisions, but I do think that ultimately the consolidation of our segment needs to happen. There needs to be more of it, and it actually is healthy for the overall landscape in tech. And so I think that the perceived him going to office could actually be a good positive for small and mid cap software names as we go into the back half of the year.
Brent, as we head into earnings here, you look at those big tech names. I know you favor many of them, but in your coverage universe, Amazon, Meta, Alphabet, Microsoft, is there one name, Brent, you'd be more bullish than the others heading into the print?
The biggest theme right now is AI, and so for us in the enterprise, that's Microsoft and Amazon for the enterprise. For consumer AI, it's Meta and Google. And I still am holding to this, and I know it's super boring, but the companies with AI that are going to win are the companies that have capital, that have users, and have the data. And those companies have those ingredients. So while everyone wants me to say some small cap or some other name, I just keep looking back. And again, I'm glad we've had this pick for the front half of the year. I mean, these stocks are up between 20 and 30+% year to date. They've been steady. They haven't had NVIDIA-like returns, but remember, AI is not out of infrastructure. It will come to software. And I think it comes to Microsoft, Amazon, and the others I spoke about first, and they're in unbelievable positions. And so we continue to have that framework for the back half of the year.
Brent, something you told us earlier this year has just really stuck with me, which you said 2024 is going to be the start of the implementation of AI, and then 2025 is really going to be the revenue year when we start to see that more. As you're aware, there's been a little more skepticism even around, not just in software, but even more broadly, that AI is going to bring all these changes that have been talked about. As we've gotten further along, I mean, that was a few months ago that you talked about that. Like, what is going to be the killer use case, or how is this all going to play out as we head into the rest of this year and into next year?
Today, it's all in infrastructure. If you look at energy, data centers, NVIDIA's outperformance. So we've talked about AI being in infrastructure. It's not in applications. It will spread, and it will come to our lives. And I think you're already seeing it in some of the products that Google has. You're seeing it in my daily use of Perplexity. You're seeing it now. Companies, many in the financial services organizations are starting to roll out Microsoft Copilot. And we're just getting initial access. So we're all going through the training. We're learning. We're not AI ninjas. I'm an AI dummy right now. I'm still learning how to use these products. And again, we're effectively, as kids either cannonball or put their baby toe in the water. We're putting our baby toe in the water right now on AI. And so we've said this, that in software, it's going to be really slow. It's going to be slower than we all think. And then it will accelerate super quick. So we're going to overestimate the near term, underestimate the long term, as they say. And the use cases are so wide ranging. Healthcare, radiology, finding issues with patients that doctors can't pick up. So you see it in healthcare, you see it in financial services, making better decisions. You see it in everyday emails, like how do you write a better composed email or ensure that you're not forgetting something? How do you do sales targeting? There's so many use cases, we could talk for hours. And I think every industry is going to be impacted, and it's going to be slow. It's not going to happen overnight. And I've said this, I don't believe, again, software this year, companies like Salesforce.com have said zero revenue from AI. So it's coming to a theater near you. It's not out yet, but it's going to take a long time. It's all in enabling infrastructure. So 24 is the year of infrastructure, highway, procure the land, build the infrastructure, the pipes, all that, and then put up these applications on top of that infrastructure. That is more of a late 24 into 25. And look, there are going to be some wild AI disasters. It's going to happen, right? And right now in my opinion, it's easier to pick the winners than the losers because we can see who's winning. Microsoft's winning. Amazon's going to win. They're sitting on 50% of the cloud computing market share. They are getting looks from many of the top companies we interact with to help their customers with AI. So we are really, really early. It's going to be a fun journey. It's going to be a wild journey. But again, I think we're like the beginning of this trail. Mm-hmm. And other companies like, Salesforce, who's coming from behind, will catch up. And so there's ways to play this too in laggards. Like, that's probably more of a 25 way to play AI, not a 24.
Well, we'll keep having that discussion as we go from dipping in the baby toe to wading in to diving in maybe at some point. Brent, it's great to catch up with you as always. Thanks.
Thank you.
Time now for To Watch Tuesday, July 16th. Starting off on the earnings front, we'll be getting more bank earnings ahead of the open, including Bank of America, Morgan Stanley, and PNC. Analysts expecting Bank of America's net interest income may reach a new low for this cycle. We'll also hear from Dow Component United Health Group, companies announcing second quarter results ahead of the opening bell.
And switching over to the Fed, we'll also be getting a little bit of Fed commentary from Fed Governor Adriana Kugler. This coming after comments from Fed Chair Jay Powell today, who said if the Fed waits for inflation to get to 2% to cut, it's waited too long.
We're also going to get some fresh economic data. Monthly retail sales were out at 8:30 a.m. Eastern Time. Economists forecasting sales to decline 0.3% in June.
And speaking of retail, Amazon's Prime Day sales get underway. The sale starts tomorrow. It's running through July 17th. Adobe Analytics predicting roughly $14 billion in combined sales for both days. That would be a new record. And that'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. Got you covered for the next half hour with the latest and greatest market-moving stories so you can get ahead of the themes affecting your money. Stay tuned.
Well,
Hello and welcome to Asking for a Trend. I'm Josh Lipton, and for the next half hour, we're going to be breaking down the trends of today that'll move stocks tomorrow. There's a lot to keep track of, so we're focusing on what you need to know to get ahead of the curve. Here's some of the trends we're going to be diving into. The Trump trade is in full effect after an assassination attempt against the former president over the weekend. Markets today pricing in the increased likelihood of a second Trump term. Trump media stock gained more than 30% during the session. Trump also kicking off the first day of the RNC by naming his running mate, Ohio Senator J.D. Vance. Plus, monetary policy in focus with a key week of Fed speak ahead as investors search for an indicator on the timeline for future rate cuts. Earlier today, Fed Chair Jerome Powell said recent data boosted the Fed's confidence on the inflation progress, adding that the Fed will cut rates before inflation reaches that 2% mark. And robust results from Goldman Sachs today point to resurgence in deal-making activity. While all seems well on Wall Street, the Main Street spending is feeling a bit more pinched. We'll dive into the latest consumer checkpoint survey from Bank of America later this hour. Former President Donald Trump selecting Ohio Senator J.D. Vance as his running mate as the Republican National Convention gets underway. The announcement also coming days after the assassination attempt on Trump at a campaign rally over the weekend. Joining me now is Henrietta Trez, Veda Partners Managing Partner and Director of Economic Policy. Henrietta, it is great to see you. So let's start with that headline. Trump does pick Senator Vance as his running mate. Henrietta, give me your reaction.
Yeah, I mean, very much expected. There was some hullabaloo about Nikki Haley potentially being the VP after the shooting and her invitation to join the RNC this week. But I think it was pretty well telegraphed in advance that J.D. Vance was going to be the guy. So most importantly for your viewers, obviously this is a member whose views have shifted quite a lot since he's risen to national prominence. On things probably most importantly on the trade front, very supportive of tariffs, weakening the U.S. dollar. I expect to see full-throated endorsements of very aggressive trade policies as a major hallmark here. His position on abortion is potentially a major problem, but one that I think Trump is already saddled with. The senator has historically supported Texas's ban on abortion, although he's migrated away from that in recent weeks, depending on which outlets he's speaking with. But I think in general, this presents another very sort of MAGA universe ticket and makes a lot of sense from Trump's perspective and in terms of the base that he's trying to galvanize going into November.
I saw this pick, Henrietta, too. I'd love to get your take on this as suggesting that Trump is very confident here. He's going to take the White House. Is that how you saw it?
I do think there's a lot of confidence, particularly in the wake of the assassination. I don't know that there's any reason to be concerned about the Senate seat. You know, Ohio is very Republican now. Sherrod Brown is in for sort of the fight of his life, running for the Senate in the state. So I think that there is some protection built in to that extent. I also think that J.D. Vance, being from Ohio, is potentially instructive on the state of the race in Pennsylvania. Midwestern states, Rust Belt states tend to vote as sort of a unit. And so choosing to go with someone from Ohio could have read through to the media universe in Pennsylvania, which I think makes a lot of sense as well strategically.
The momentum seems to be with Trump right now, Henry. I'm just curious to get your kind of temperature check on the Biden campaign, where they're at now and where you see them headed.
Well, right now, I think they're in a state of suspended animation. I mean, the whole entire Democratic Party, I thought, was very much trending towards getting Biden out of the race. He cannot win another term, is basically as blunt as I would put it. Kamala Harris fares better in all of the swing states, and that is what the Democratic Party needs right now. 62% of Democrats, per one of the polls that came out this weekend, don't want Biden to be the nominee. So I think in the wake of the shooting, what's happened is that Democrats have suspended all their campaigning. But now with the announcement of J.D. Vance, that's going to pick up again. So we got, 72 hours of reprieve, and now it's going to be full steam ahead. And the Biden camp is going to have a lot of very difficult conversations still with donors, with the DNC, campaign officials who are already presenting very detailed programs and sort of ways of getting around having Biden on the ticket, having an open mini convention that starts after the RNC. I think those calls are going to pick up as we head into the next couple of days.
Is your bet right now, though, Henry, when you're talking to your clients, is your bet that it is, though, Biden on the ticket?
No, it's not. I'm at 70% that Biden will not be on the ticket. I see Kamala as the next most likely candidate, the vice president. I think that for a whole host of reasons. Number one, a number of the potential replacements, Gavin Newsom or Gretchen Whitmer, are not engaging in the process right now. Number two, I think technically it's easier from a campaign finance perspective. And number three, I think as vice president, as someone who's got the firm backing of Jim Clyburn and was moved to the top of the ticket back in 2020 for this very purpose, I think skipping over her would be wildly unlikely. So I will admit that my odds are a little bit in flux because of the shooting, and I'll migrate that as we see polling data. In the absence of data, my expectation remains the 70% odds that Biden will not be the nominee on the Democratic ticket in November.
But and yet, Henrietta, when you listen to President Biden in these interviews, he's so adamant, Henrietta. I mean, he makes it, at least he says, listen, I'm not going anywhere voluntarily. So what's the mechanism you sort of get through that or around that?
It's more than anything, it's really just time. I think that the Democratic Party is being very conscientious of their support and respect and adoration for President Biden, who's passed 4 massive pieces of legislation in the last 4 years, including 2 reconciliation bills and 2 bipartisan bills, in something that we haven't seen in modern history, whether it was Obama or Trump in his first term. Pulling the United States out of COVID, having the lowest sub 4% unemployment rate since the 1960s, massive wage growth. These are all things that the Democrats are very, very proud of, and they're not going to boot Biden unceremoniously. The reality is his age is a real problem, and he's not able to combat the narrative that Trump is selling, and that is the issue.
Henrietta, great to have you on the show. Thanks as always for joining us.
Thanks for having me.
The Dow hitting a fresh record close while the S&P 500 ends the day just below a record finish. For more on the trading day takeaways, let's get to Yahoo Finance's very own Josh Schaefer. Josh.
Hey, Josh. Yeah, we've been following the broadening of this stock market rally over the last couple of days, and we got some more signs of it today, specifically with the Russell 2000 and sort of the sector action. So I'm going to start with the sector action that we had today. You'll see in front there you had energy and financials and industrials all leading. Notably, perhaps, you have tech coming just in shy of the S&P 500. You also have communication services not really on the front end of this. And this has been the trend really for the last 5 days now since we had that inflation report that came in better than expected and the market started to price in a September rate cut. This has been the trend. It has been a broadening of the rally. Look at real estate and interest rate sensitive sector leading the S&P 500 sectors. Of course, when you zoom out to the year, that hasn't been the story, right? It's been all mega cap tech. And then sort of these others, look at real estate's barely even up on the year. So you've seen kind of this shift into this rotation. This is, of course, not the first time we've talked about broadening of the stock market rally. We talked about it a little bit back in February, March. We talked about it last December, and it hasn't really stuck. So kind of the key question I've been talking to strategists about today is just, is it going to stay? And what does it sort of take to stay? I think that's where we're at right now.
And when you talk to these folks, Josh, what are sort of the indicators, the signals they look for about whether that rotation actually does stick?
So here's a big one that Bank of America's Oh-Sung Kwong highlighted to me. This is expectations for earnings for Mag 7 versus the S&P 500. So Mag 7's in purple, the rest of the S&P 500 493 is in light blue. Notably here, we've just been seeing purple going up, and we haven't seen blue go up for a long time, right? Well, this is this quarter. You're supposed to see the 493 come out of their earnings recession and start to post positive earnings growth. And sort of the key question is going to be, A, do they do this? Because remember, this is just expectations. This is just what Wall Street expects. So do we get this? And then does it continue through the rest of the year is one of the key fundamental questions. And then, of course, there's the Fed rate cut side of this, right? And do we get the cuts that we're pricing in? Do those come? And if they do come, how many are we getting? Is it because the economy is doing good or bad? That's sort of where the front of the questions are here. And that relates us to our second topic.
There you go, the pint-sized companies.
Yes, Russell 2000 hitting its highest level in 2 years since 2022. And I'll just pull up the chart here for us. But really, the Russell has kind of been a great barometer for how people are feeling about rate cuts, right? On days that people are pricing in more cuts, potentially pricing in Fed easing, you'll see that the Russell does rather well. So we can get to IWM here, which follows the Russell 2000. It's up about 7%, I think, in the last 5 days. Yeah, 7% in the last 5 days. So this has really rallied compared to the S&P 500.
And do you think that rally in those small caps, Josh, is that on just the rate cuts expectations? Keep it that simple?
It is. And what's interesting, if I can get us to a year to date here, you'll see we've had this happen before. And then it falls off at times, right? We get this rally. This is when people were feeling more optimistic, and then it falls off. The interesting thing that strategists were telling me today, this was Callie Cox over at Ritholtz Wealth Management, she said she thinks once we get the cut. So if the cut comes in September, normally small caps rally after the cut. So it's interesting that we're starting to see this movement now, but some strategists aren't necessarily thinking it's going to stay. They think the real rally probably comes after we get that cut. And unless we suddenly get a surprise in July, it's not supposed to come right now, Josh.
All right, third Schaefer takeaway.
The third takeaway, and I sort of tied all these into the broadening,
Bring it all home.
tomorrow we have retail sales. And the thing that I sort of took away from talking to different folks today was things like retail sales. You kind of want it to keep coming in like the data's been coming in, which is not too hot, not too cold. You look at tomorrow's expectations, retail sales are expected to fall by about 0.2% on a headline, up slightly if you take out auto and gas.
Yep.
That's a good report for the market. You don't want too hot of a number where people are going to get concerned about inflation, but you also don't want a weak number. People are worried about economic data coming in weak, and if economic data comes in weak, and that's why we get cuts, all the broadening stuff we just talked about for 5 minutes, that whole trend kind of goes out the window because you need the economy to doing well. So it's going to be interesting to just keep watching reports like that at 8:30 when they come out for the market.
Likely the big economic data print this week.
It's all we got this week, really, Josh.
All right.
Until Netflix earnings, right?
Thank you, Josh. Appreciate it. On the other side, a check-in on the state of the consumer with the Bank of America Institute. More Asking for Trend on the other side. Among the headlines so far this earnings season from big banks, consumers are feeling the pinch of inflation. Consumer Checkpoint report from Bank of America Institute provides a more nuanced view, though. While credit and debit card spending fell slightly in June on a year-over-year basis, trends within that spend point to broader momentum in the months ahead. I'm joined now by Liz Everett-Chrisberg, head of the Bank of America Institute. Liz, good to see you.
Great to be here.
So as we're making our way through earnings season, there are some CEOs from some companies, Liz, kind of sounding a bit cautious about the consumer, but you have a much broader view. What are you seeing?
Well, let's start with what you were talking about in terms of consumer spending. As we mentioned, in June, credit card and debit card spending per household dropped down 0.5%. So not significantly, but that was the first negative spend in 4 months. So we are seeing that momentum slow down. But if we kind of come back, since we're in the middle of earnings, and look at the second quarter as a whole, consumer spending momentum was still up about 0.3%. So the consumer is, I think, softer than they had been, but they're still pretty stable.
All right, no alarm bells going off. Is what
No alarm bells going off. Now, if we dig into the composition of that spending and look at services versus retail spending, one thing that is relatively consistent is we continue to see services outpacing the weakness in retail spending. But dig in a little bit further, what's driving retail spending? One of the big decliners there, gas. Well, why is gas spending down? Because the prices at the pump are down, right? And what are people spending on, and where are we seeing increases within retail spending?
Where are they spending?
It's
Tell
the
me, Liz.
necessities.
Yeah.
So it's food and it's general merchandise. What are they not spending on? Furniture's down, technology's down.
That's interesting. So is there one trend, people spending more on, okay, I'm going to focus on what I need more than what I want right now?
That's what, if you look at those categories, it would say. Now, something else people are doing on the services side is traveling. Although travel spending, it's, oh my gosh. And you thought last year was like revenge travel?
Yeah.
This year is revenge travel. And they're both traveling internationally and domestically. But internationally, this isn't in terms of the dollar spent, but the people with the Bank of America cards who are swiping when they're traveling internationally is up 6% over last year and 30%, more than 30%.
Does that surprise you, Liz, those numbers?
Well, I'll tell you why it doesn't really surprise me in June, because Taylor Swift was in Europe.
Yeah, that did it.
23%.
That's incredible.
Of course. I mean, there's got to be a Taylor Swift account, stat. But it wasn't. They weren't just spending money on the Taylor Swift cons. When we're seeing Bank of America consumers traveling abroad and spending internationally, they're also then spending more on retail while they're traveling internationally. And I said 6% up in terms of international travel. It's up about 3% domestically, and we measure that by looking at purchases outside of someone's essentially city or regional area.
Let me get your take too. Jay Powell was speaking today, and obviously he touched on the labor market.
Yeah.
You see signs that it's cooling. When you look at the labor market, Liz, is there anything that concerns you in the data?
I wouldn't say that anything concerns me in the data, but what we look at, again, at the Bank of America Institute, we're really leveraging the 69 million consumer accounts that we have, and we can see the money that's coming into accounts. So we can measure the after-tax impact, what's really driving consumer spending. And what we're seeing is we are continuing to see income growth, particularly for lower and middle income households. But that growth rate is not as high as it had been 2 years ago. It's relatively stable. And a lower income household is up about 3% in June. Higher income households up about 1.25%, so less. But you are still seeing the labor market. There's signs of a slowdown, but really not significant. Not that anything that I'm particularly concerned about at this point.
All right, we'll take it. Liz, thanks for joining us. Appreciate it.
Thanks for having me.
And coming up, a look at how the average portfolio has fared under different administrations. More asking for a trend on the other side. What would happen if you were only invested in the S&P 500 when a particular political party was president, and how much would it matter? Yahoo Finance's Julie Hyman joins me now with a closer look.
So, Josh, this is a sort of an exercise that shows the most extreme example of if you let your personal politics interfere too much with your investing strategy. It's a safe bet that there probably aren't too many people, if anyone out there, who just pulls their money from the market during the administration of the opposing party when they are in power. So, but that said, the point of this exercise from LPL Financial is to show, in their words, that it's policy, not politics, that makes a difference. So their exercise is they take a look at the S&P 500. They suppose that you invest $100,000 in 1950 in the S&P. Now, if you only put your money in when Republican presidents were in office, you would make $1 million by now. If you only put your money in when Democrats were in the presidency, you would do better, quite a bit better. You'd make $3 million. However, if you just kept your money in the whole time, you would be making $32.5 million from your original $100,000 investment over that period of time. This is sort of another way of saying the market tends to go up over time, right? That is the general direction of stocks here. And it's also another way of saying it pays to stay invested in stocks. So we talked to LPL Financial's Jeff Bookbinder about this idea earlier, and this is what he said.
We have remained fully invested. That's been our recommendation. We're neutral on equities, and it really takes a lot to move us much off of that. The numbers here are very compelling in terms of staying invested. So certainly there were some Democrats that missed out on gains during the Trump presidency before. There's certainly the opposite as well. So yeah, staying invested, the stock market goes up something like 78% of the time. Staying invested over the long haul makes a lot of sense.
Now, he noted he's neutral. Now, that doesn't mean he's pulling money out of the market, but it also doesn't necessarily mean he's putting more money to work. But again, staying invested is more the idea here, Josh.
And Julia, another comment on this very topic comes from Peter Bukvar, a strategist we both know and love. He says this, Julie. He says, everyone is passing around their favorite Trump trades, but I think we've seen over the past century that stock market moves are more random than what a president can dictate. I think in some ways, speaking to your chart there.
Yeah, and that's something that our Rick Newman has talked a lot about too, that any single president doesn't have that much influence over the overall market. Now, that said, there are certainly pockets in specific industries where you might see more of an effect. We've talked about the solar industry. We've talked about electric vehicles, for example, and certain policies that can be more favorable for certain industries. The oil industry, for example, is seen as benefiting under another Trump presidency. So those might see some movement, and there might be some fundamental effect. It's harder to make suppositions about the market as a whole.
All right, Julie, thank you. Appreciate it. And moments ago, Ohio Senator J.D. Vance arriving on the floor of the Republican National Convention about an hour after former President Donald Trump named him his running mate. Vance is greeting supporters on the floor and the delegates who voted to officially make Trump the Republican nominee earlier this afternoon. And that is wrap on today's Asking for a Trend. Be sure to come back tomorrow at 4:30 p.m. Eastern for all of the latest market-moving stories affecting your wallet. Have a great night.